Hey guys, how are you doing? Yep, it's the market sniper. That's right. So many people asking, so what direction is the dollar gonna go? Where are we heading? What's happening? Where the market's going? Everybody wants to know and understand after recent events, because we've had sustained period of dollar strength for quite a while. Then we had a vicious pullback. We've just recently had the non-farm payrolls. Now, we suspected that was going to come in higher than people expected and stated it. But we also state that the NFP is an untrustworthy, unreliable number, and that the market is in fact far weaker, good people, than you think it is. Yep, hit that like, hit that subscribe, pump that up, fool that algorithm, take it in there, smash them up, get them loving market sniper again. Yep, so this over here is the dollar index that I'm looking at, and people have seen it come down for quite some bit. But the problem comes that everybody who's saying peak dollar, is that if the market is as weak as I am saying it is, and I'm suggesting that it's pretty weak, what actually is the natural flow of events? So this video is entitled, this recording is entitled, Why the Great Rallies, or I won't call them great, the rallies that you are seeing currently are the ideal setup for shorters. For a macro collapse to the downside, I would suspect early in 2023 in what will likely be a big ass recession, and probably even more so, because I just don't believe we do normal recessions anymore. So you're seeing a little bit of a bid coming back into the dollar index now after a dull period. It's come quite some way off the 114s. We've told people before it met our big targets. Now it's having a pullback, but it'll only go so far. What happens when the market wets the bed? What happens when the event risk? This is our core scenario. Right now you've seen a little bit of a rally in the Dow, a little bit of a rally in Bitcoin, a little bit of a rally in everything, the euro, the pound, all these things. And the problem there, and all at the expense of dollar softness, the problem there is the great recession stroke depression that is about to come. The 2023, it might even be a Christmas Day gift from the powers that be. Who knows? They love a good surprise when it comes to us. It may well be. But if I'm looking at the US dollar, I'm warning people against getting too bearish on the dollar. What happens is the dollar gets bid. The dollar gets bid when the fear and the pain is coming in. Welcome to all the Instagram viewers coming in on the bottom. Welcome. You'll see the charts later on YouTube when you watch. So the dollar index for me overall has had a pullback. It did make a significant target, but it will ride again. The euro problems will come back into focus again. Thanks for the hearts, the loves, and the smiles, and the licks, and the subscribes. The pound is going to run into the same trouble again. All sorts of problems are waiting for the British pound, and it doesn't have the scale, it doesn't have the global economy. So let's go back to that non-farm number. That was coming in as fairly strong. The labor market is not as strong as they tell you. And it's not just me who says that. And I've been saying this for a while. And it's my opinion, we did go into a recession because the technical definition of a recession was met. That all happened, good people. It happened. It did not happen just because you don't want it to happen, because the Fed says, no, the labor market's strong, so that old definition no longer applies. You went into a recession, but they're so far behind on inflation that they're going to over-tighten, and the game is over-tightening, and they're going to be tightening into what is now already, in our view, a recession that's getting deeper. And that's the worst thing you can do, is to be tightening in a recession. Too slow to tighten, too late to come off the gas, lagging every time. And I want to show a couple of things that a number of people have highlighted. But I first want to remind people a little bit of some of the risks that are out there. So I'm looking at an article on the Bank of International Settlements. It has warned that pension funds and other non-bank financial firms, remember, your pension is invested in the debt markets. I know you don't want that. Get out of it. Get it self-invested. Get it out of there. Off-balance sheet dollar debt in the form of FX swaps to the tune of 80 trillion. That are hidden. This is an Enron story, friends. This is, we're an awesome share. We're doing great growth. We're doing really, really well. And all the crap gets put off the market, off in an unlisted non-balance sheet item. We have 80 trillion in our pensions system of swaps. And the Bank of International Settlements, this is what I call establishing alibi. Essentially, they are saying, for when this blows up, we need to have proof that we can say, we told you so. Don't look at us. We said it. It's going to go bad. Here's one of the reasons why. The tightening of this interest rate, good people, is such that the interest rates are now higher than the previous crash, but the debt is larger. So what has actually happened is you have a higher Fed's fund rate than the last time when you tapped out. Don't forget the repo markets went first in 2019 before they hurried through their lab flu for the lockdowns. Oh, on lockdowns, by the way, that's likely to come back. A little bit of an article as we say goodbye to the Bank of International Settlements and their great news of 80 trillion. The Oxfordshire Council to trial a climate lockdown starting in 2024. Oxfordshire County Council passed climate lockdown trial. So Oxford University, by the way, it's kind of like Harvard and MIT and Stanford. It is the spooks university. It's where all the insider dark state cartel go get a bit of programming and go and get hooked up and hired. There's plenty that goes on. Oxford and Cambridge are the same here, and they get artificially branded as super elite, which isn't always entirely true. But it certainly has the members of the dark state deeply embedded both in the professorship, the academia, the thought papers, the people that lead, that are taking the narrative forward of what we should be discussing, are all academics and professors at the lovely universities of Oxford and Cambridge and get a shitload of money sent down their way. That's right, so that they can come up with climate lockdown policy. So the great lockdown game is going to come for many other reasons. Once they've established a power over you, they are not going to give it up. They need to continually to exercise it to keep you in subordination, my good friends. But let's keep this financial. Let's not go too far down that one. I want to also remind you the Fed's secret repo loans, another news blackout and a French bank scandal. So you've obviously already heard about Credit Suisse, the good old Saudis being the bailout. Remember the fork of who they are, frenemies, but actually part of the same lineage, bailing and keeping Credit Suisse going for now, and in being an anchor investment in a really crap bank where we have such derivative problems that we actually need BNP Paribas. I wonder if that will go a little bit bigger. No, it didn't go bigger, but it did isolate itself. BNP Paribas were sent March 31st, 2020, and I'm going to go through a couple of banks. There isn't just one, good folk. 3.84 trillion. Essentially 4 trillion. A rounding error, 4 trillion, my friends. And let me tell you, there aren't very many economies global that have more than 4 trillion as a GDP number. This bank got sent one of the biggest nation-sized economies in a single payment from the Fed in one hit. It's kind of like getting your entire decade of salary given to you, and I just send you a check and here it is. Everything you've ever earned, all the income. Only you're a big earner. You're one of the biggest earners in the world. You're not, you're a C-class executive. Imagine that. By the way, in case you just thought it was BNP, Citigroup got 2.67. Goldman Sachs got almost 2.85 trillion. JP Morgan, the Fed's bank, 3.6, almost as big as good old BNP Paribas. Barclays Capital, 2 trillion. Nomura, that's a Japanese investment bank, by the way, 2.7 trillion. Why are they being sent Trillions, guys. This is not billions. You need to understand that difference in scale. Million, billion, trillion. I'm not going to go and do my usual explanation, but you know by now that is unbelievably big. That is unbelievably big. You know, it's just beyond all description. This article regularly disappears. And I found someone kindly gave it back, sent me a link for one place that is still holding the article. And you know, I'm finding it hard even to find it on Zero Hedge. And there were more. There were about 8 banks in total. The secret repo loans that they kind of declared and then stamped out, and Powell didn't want any questions on that. So we'll talk about numbers where hundreds of millions, couple of billion here and there are being spent, but sending 3.6 trillion to a single financial service. Why do you think they're doing that? This is a controlled demolition of the global economy, and some financial institutions want to crumble already, and they aren't yet quite ready to allow the whole parade to fall down. They are holding up certain things that are wanting to fall too soon, that have been too well weakened, too ahead of schedule. And there are other things that they still need to weaken up and coordinate for their big moment. That is where we're at. Wall Street on parade. The Fed's secret repo loans. Yes, sir. Yes, sir. 3 bags full. 2 plus 4 is 6. Plus 2.5 is kind of 8.5. Plus essentially 3 is 11.5. Plus 3.5 onto 11.5, you've got about 15 trillion there, plus 2.7. 17.7 trillion in the top 6 banks, and there were many more. 17.7 trillion. 17.7 trillion. Let's just be clear on that. The American economy is only 15 trillion in GDP. The entire of the biggest economy of the world. You've sent the biggest nation's economy of the world to 6 institutions, to 6 companies. Think about that. Okay, and what's the risks of downside? All the risks are downside, yet you're getting rallies now. I want to pivot now to the crushing recession, depression incoming that we are calling, and that you're getting rallies right now on certain things and little bids. And you're not to be fooled into these, my fine friends, because these little bids up are little traps to later spank you much, much harder to the downside. New orders to inventory. So let's just have a look at this graph. And congratulations to the guy who shared it. So I want to highlight the new orders to inventories. Okay. So essentially, businesses have stuff on the shelves and in the back room. Think of Amazon, a warehouse. Stuff is coming in and going out. The question is more stuff coming in than is going out, or are you bleeding out inventories and you need to stockpile a little bit? So what's the rate of inventories disappearing and coming back? What's the rate? So 50 is essentially the midpoint, fine people, and I'll put it in luminous green, the Market Sniper logo, and I will highlight to you in TG Pink, I will highlight to you in Transgender Pink that there's been very few occasions. There's very few occasions where you had a significant dip below this line. In other words, you are net disaccumulating at a rate. And when that happens, it usually skids into a terrific disaccumulation, where people are just not buying and stocking inventories at all, and they're doing sales and they're just trying to shed what they're carrying. And that happened in 2000 through to 2002. So let's just try get a square there and do this properly. 2000 to 2002. Incidentally, I was doing this chat with Premium earlier on today. If you want to hear exactly what they're thinking before and the greater detail, you should go to themarketsniper.com and book a call, have a chat. There is real opportunity to build wealth in a crashing environment. It sounds like it's just perma-bear stuff and it's negative and misery. No, it is just what it is. When we're bullish, we've been bullish. But right now, there is all the setup for downside. There is very little melt-up upside risk, which is why I've treated certain people with some scorn. And there is immense potential for downside risk. And the other 2 times were 0809, known as the subprime crisis, where you collapsed to 31.3. Note, these are typically real hard collapses and snapbacks because everybody just dumps. Nobody is buying and everybody just gets at really low prices. There's a massive rush for liquidity. People don't have cash. They sell anything for everything. It's a dash to get cash. because things aren't worth it. Toys on Amazon aren't worth it. Nobody wants any of your stuff. They need to pay bills. There's all a push. There's a liquidity crunch. There's a push to meet rent checks, car payments, and there is no fluff. It's not about holidays and luxuries at that point. The other time, of course, being the 2019, beginning of the repo into the beginning of 2020, which was the event called the pandemic. That's how we'll refer it for now. So those three major events, and you are now already at 46.6. That is well below the 50. You only had a couple of times a small touch through the 50 line, and it reversed very quickly. One was in 98 when there was an Asian crisis, and it just did a small dip below and bounced straight back. And again in 2012, we were so weak in our recovery. Again, those were super small. What you can see is that right there is not the same. It's already beyond the realm of that and that. That you're seeing right there is going to do the mega dip like the other ones. Pivot to the pink. And if you think it's got easier and better, I'm here to tell you that they've lent more. There is more fiat in this realm. There is more Ponzi money out there. And the interest rate is higher than it was last time. The cost of carry is higher. The likely pressure on derivatives. Whatever happens, whether they do a new pandemic, whether they do a Taiwan-China war, Russia-Ukraine escalation, global hack, whatever the case may be, any number of narratives. You will get a narrative just like you had the dot-com narrative, the subprime property narrative. You will get a narrative in the end. But what's coming cannot be argued about. What's coming, and there's likely to be some element of a credit risk that's going to go along with what I'm showing on this chart. And for those on Instagram that are following, go and have a look at the World New Orders to Inventories tweet that I put out on our Twitter. Are you following us on @TheMarketSniper, @TheCryptoSniper? So to my friends in crypto, do you think that this major dump in inventories, real world, that is likely to have a crushing effect on equities, Nasdaq, Dow, S&P, risk off assets after you've had a little bit of a property boom, but now interest rates going to 7. They're still going to do a hike in December, hiking into an already recession that was a qualified recession quite some time ago, quite a few months ago. This job market as being strong. Let's go back to where we started, and the job market being strong. So check out every now and then our boy Alf, Macro Alf. He does some good work. Check him out. Where's he go? There. Let's go in here. He's quite correctly pointed out, Macro Alf, we're looking over here, the massive easing in financial conditions in 2020 and early 21 led to a hiring spree. So what he's saying is, you throw 7 trillion into the world and the economic system, and you say, here, everyone gets one, furlough, stimmy, everything. Guess what? People are buying, people are doing stuff, there's stimulus all abound, people go into a hiring frenzy because you need workers. You need workers to help you sell stuff. You need service provision. This is a highly buoyant economy, only it was fakely buoyant on proliferation of money that then caused the inflation that you're now fighting, that see them now tightening into a Santa Claus rally for equities and a mild bid up despite counterparty risks and everything that can still come out in crypto on Bitcoin, which we said could possibly happen, is not long run good, guys. This is the setup to something far darker. The significant tightening since in financial conditions in 2022 will lead to the diametrically opposite effect. This is what happens. You create a pumpumental and you get a pump, and then when that money leaves, which you've created on leverage and everyone's borrowed and margined up against, and they close and they sell, the bid disappears. You get dumpumentals. As sure as you get a pumpumental, you get a dumpumental. And it's the scale is naturally pettified. In fact, HVF method makes use of this in terms of how we do targets, how far you move up, before you find a bid again on a major pullback is the natural geometry of the market. In other words, how much money was there to drive it up and how scared was it to pull back out before it found a new bid gives a natural geometry to the markets. And Alpha is making a very similar comment. This time is no different. The mega Pumpumentals that was caused in the hiring environment that you still got a tail end of is now retreating chronically with the interest rate hikes. And this will affect real estate, knock on. Of course, you've had the energy costs that have made it more expensive for many people to do various things. Plus, they're having to pay working wage increases. So there's costs increasing on businesses. Their petrol's gone up. Yet at the same time, people's disposable incomes in real terms have never been lower. Square that circle. That's what inflation does, my friends. It makes the poor, the working poor, the middle class, and even the upper middle class worse off, and the billionaire class richer than ever before. It literally lifts the casino table up like that and sends all the chips to the other side of the table where Fat Boy with his cigar is having a good old tug and his mates are jacking the table up. And guess what? All that becomes his. And that's what happens. And so as a result, we're expecting the drain away of this power in the economic market for employees. The narrative that the Fed has pushed is that no, we're super strong. The retail employment market says that this is not a recession. Let's once again go and have a little look at our inversion curve. In fact, I've got a couple of inversion charts for you that I was going to show. Let's have a little look where they are. US Treasury yield. So this just shows you where the 1 month yield is. It's above 4. In fact, they're all above 4 right the way up to 3 years. And then the long-term debt is down here at 3.5. So actually, you take a macro 30-year debt, you subtract any of them, 3 years, 2 years, 1 year, any of these data points, and you are below. You have a negative value. You have the yield inversion almost across the curve. You have the 30-year barely at 3.6, and you have everything from the 3-year, the 2-year, the 1 year, the 6 month. What does that mean? The short-term borrowing is seeing that the Fed's going to be increasing rates and has to be a high interest rate. The long-term is pricing in a recession. It's not going to pay that level of rates. It says, no ways. You're all going to be rushing in to buy me. In fact, I'm already pre-pricing in an economic collapse. I am already pre-pricing in an economic collapse. Look at your 10-year, sub 3.6, in and around the 3.5s. All of these minus any of the shorter term rates, and it is significantly lower. This can be seen in a chart format, which I'm more typically prone to do. Here's your 30-year. I am highlighting to you that the 30-year less the 3 month, which is one of the most popular curves that people watch. Don't forget to hit the like. Welcome to the Instagram, guys. Welcome. Welcome to the YouTube, guys. Are you subscribed? Hit the bell, notify always. Unfortunately, they changed that. You will see that this has actually run the subprime lows, and it has actually run the dot-com lows on yield inversion. And it has done so at a vicious rate and still carrying some momentum for that. So that is showing if you're getting a violent yield inversion that is happening brutally and quickly with high momentum. That does not spell nothing much. It's going to be something small, soft landing, all of this nonsense. This points to a big deal event. And they were going to have to create a story, a war, or something else to mask the economic fact. Because it can't be down like the Fed, you failed. They need an excuse. They need that black swan that they can blame. Who could have seen the pandemic, they can say. I'm an economist. I'm not a clairvoyant that can see health events. They need the cover of, it was random, it came out the blue. The problem is we've needed more and more random events to keep masking the absolute mismanagement of this globalized economy of central banking cartel for all the perpetual crisis they are bringing down on our head that has caused such inflation. They're going to need a demand destroying event. Something like locking you in your homes might do. You spend a whole bunch less. Something other options may also exist. But this is a violent correction on the yield curve, and it has surpassed big crises, including the 2019, including the 2007-08, which were all before, and were leading indicators of major recessions / depressions. In my opinion, you can almost categorize all three of these as depression economics. You can do it for other durations as well. You can do it for the 10-year. It's pretty simple. Change it to the 1 there, select it, and you will see in some instances it gets even more extreme. Even more extreme. It is lower and has surpassed all the major economic events. Okay, so that's that. What else do we know and what else have we learned? Well, we've also learned, if we go back to a point Alf was making, in December 2000, which was pre-dot-com, which is one of our crises for the inverted, the yield curve was deeply inverted and the stock market had dropped 15%. In December 22, the yield curve is deeply inverted and the stock market has dropped 15%. Well, it depends what you mean by the stock market. The Dow is actually only about 7% off, but you might find that the Nasdaq or the SPY is closer to that. History doesn't repeat itself, but it often rhymes. Is 2023 to be the new 2001? 2001, as you probably will remember, was a very soft year. And that's when Greenspan decided to cut rates so low that he created the makings of the next soon-to-be housing boom, and then handed it all over to Shlomo Bernanke, the world's greatest economist, who won a prize recently. You can't write this stuff, my good friends. You can't write this stuff. So that is a little bit about that. Let's see. I was going to do a little bit more for you on the labor. This was, again, Alf's newsletter, which, as I say, is a good shout, worthy of a follow. There are statistical adjustments that abound in the established NFP number survey that make the employment look better than it truly is. In fact, further to this, it's not just Alf that was highlighting this. It's actually, you can find it on Zero Hedge as well. If you pop over to here, you will see, here is the difference, and it's some difference. We're talking about 2.7 million jobs, my good friends. Household versus establishment survey. So the household, that is by household of people who are actually working, versus some of the many very bold assumptions that the birth-death model and various other business surveys that say if you've started a new business, that means you've probably hired some people, which is quite fluffy and assumptive, have a 2.7 million difference. So in short, employment has actually been pretty flat on the household, yet it's been projected to continue to have climbed, and it's roughly in and around, when was it? There was a year change. It's a bit small. Let's see if we can get this chart a tiny bit bigger. There we go. You can see roughly around March of 21. We all remember what was going down round about then, that the household survey flatlined, and the non-farm payrolls, everything is awesome. They keep giving J-Pal permission to tighten, which will lead, in my personal opinion, to a number of things, but a credit event which could involve derivatives, a la those great trillions that are needed to keep 6 financial institutions from keeping going. Wow, that is unbelievable, guys. What do you make of that? You tell me. How does that all sound to you? Does this sound like a good grounds and base for a growing economy? Do you see upside surprises in any of this? I personally do not. So what does that bring us to? Well, it brings us to the fact that on the charts, for some people, they are actually seeing the likes of, say, let's take the equity markets. We'll go past Bitcoin as well. The equity markets, one of the best ways of taking some of the steam out of this oil market and the energies that have been strong, nothing better than a demand destroying event. So if we go, how far is the Dow from its highs? The Dow is around 6.35. If I include its current trade there, it's around 7.8%. So that's about 8%. If we have a look at the SPY, how far is it from its highs? It's about 14%. Yeah, it's not bad. I think he was referring to the SPY, was Alf. Which is the right index. It's 500 equities. The Dow, of course, is just a limited number. He's saying roughly approximately 15%. And then they were still the important part with us. We've added more debt and we're still tightening, and there's a rate increase coming December, guys. A rate increase, even if it's 0.5, even if it's 0.25, there's still a rate increase coming. So that's a great game, and how that works. So you are weakening, employment is actually probably stagnating, and they are following a fake number with lots of assumptions in it, which both Zero Hedge and other analysts have highlighted as having fluff in it as their benchmark and validation. And we've brought this point up before. We've never said it specifically in the headline of a YouTube, but the Powell needs to keep weaponizing the dollar and to keep it strong and aggressive. So what are they doing? They are tightening. They are tightening on a non-farm number, which is over flattering. Let's move on. Let's move on to what else we want to tell you. So with that going on, with all of that going on, is it a good environment to be long equities? Is your pension that is long equities going to go well? Even energy markets that we've liked will find problems. They are going to sell off. If we have the scale that we think we will have, this is going to be a very contractionary environment. And I would expect oil to come back. You've got WTI back under the the $80 mark, and it can fall further. Natural gas is even starting to come down. It was a stubbornly stronger. Don't forget, you have the Germans in real trouble, and the British and everybody on energy. It's a great time to kill the energy markets a little bit back down. You have the Nasdaq, which is in a different level of trouble. We called a head and shoulder. That head and shoulder probably still to be made just. But if we go from there down to where the Nasdaq currently is, the Nasdaq is 30% down from its 7 trillion Pumpumentals. So when you remember 30% down, do please remember that it did first, before then, go up on the lows of COVID. 87 bars on a weekly, 87 weeks ago, 144.7%. That's what 7 trillion did. That, my friends, is what 7 trillion did to the lows of the Nasdaq COVID. That's what pumped ARK to the moon and made Cathie Wood a household name. Suddenly, everyone's talking about Cathie saw it first, Cathie bought it first, Cathie's in there, Cathie's moved into metaverse. Cathie Wood and ARK during that period went on an even bigger run. But just the Nasdaq generally, which had many trillion caps like Apple. In fact, Amazon is the first to lose 1 trillion market cap. What is Amazon's clients? Retail. You buying your stuff on the New World Order. Online, all shopping for everything business. That's right. Stop doing that anyway, by the way. But nonetheless, you're doing it less anyway. That tells you that they've lost 1 trillion. The first market cap company to lose 1 trillion in market cap. It's more than half from its high. And it was well through 2 trillion when that happened. So the Nasdaq is down substantially, and it can go down further. If we choose some of those individual stars to do an update for you, many will say, but all the damage has been done. They're already down so much. you got to look long enough to understand how far up they have gone. So if I just take the ruler away and pull this through, if you just have a look at how far they have gone, the Cathie Wood's ARK has just returned to where it was at the COVID's low when it was already a fanboy favorite. But during that period on the high side, it actually went up in percentages 384%. In the space of 48 bars, which is 48 weeks, less than 1 year, Cathie Wood's ETF went up 384%. That's 4.8 times. 4.8 times up. Don't forget, you could have had it in 2016. You could have had ARK for around $20. Let's check it. $14.89. So when it was at the lows of COVID, it was already still 124.9% up. It was still 125% up from 16. So it has become an absolute banner for the Pumpumentals metaverse tech stock. So this is our big point. So what are we saying? What's our point? Where are we taking you with all of this? It's quite simple. Going back to the logarithmic chart here, it's quite simple. There is a major demand destroying event coming. The economy is not as strong as you think it is. It's deeply, deeply weak. Actually, it's probably in recession and facing tightening monetary policy at the same time as it's in recession. That is devastating combination. A tightening of interest rates, especially for tech stocks that are indebted and have borrowed and done many things and don't pay dividends. In that environment, good people, you are sitting on a potential collapse. And what's actually happening now in between, while the dollar had a rest and a pullback, you're actually getting small rallies. What happened to Bitcoin? Let's go to Bitcoin and show. We called it. We said there's going to be a slight drift up. It's going to be a dangerous time. I take all the drawers off and I just show you this. It's going to be a dangerous time. Despite all the bearish news, you've got a little bit of a bid up. And everyone's going to call a bottom. The people that think everything is the moon are now calling this a bottom. Because everybody wants to moon the bottom. That's what happens. That's why they call it mooning, I suppose. They were all calling the bottom, going into one of the worst depressions that we're ever likely to see, in my opinion, because we've never been so indebted, we've got higher interest rates than before, and the employment environment has never been actually as bad and turning as bad. It's flipped, and it's not nearly as hot as what they try to make out, yet they are looking at the non-farm flawed statistics to validate and justify an ever-tightening interest rates. So here's the message. There's real opportunities to make money amazingly in this environment. In fact, shorts perform faster and quicker and delve and bring great potential profits if you are positioned correctly for it. But within that, there's counterparty risk. Things can go bust. In terms of crypto, I don't even know who's properly solvent anymore. In terms of equities, you can get puts. Those contracts will hold. Shares and equity contracts will hold. There are counter-cyclical things that can do well, that can actually be buys. But generally, the best moves are going to be to the short side. And while you are getting these rallies to the upside, it is the final. It's the Indian summer. It's the final long days, the final rays of sun before a long, harsh winter in terms of the market. And that is as a result of excessive debt, increasing interest rates, a turning down employment market, a crushed retailer that has already seen the likes of Amazon fall by more than, lose $1 trillion in market cap, which I think is close on 50%. We can get an actual percent for you. Do you have any questions for me? Those on Instagram that have been posting, those on YouTube, post your comments when this goes out. Do you have any questions for me on this admittedly very dark? No, I'm not a misery. I would love a legitimate Mises authentic money system that's not a fake fiat proliferation at the arse end of its life. I would love to be around where a message is actually not coming out the way this sounds. But as long as it is what it is, I'm going to call it what I believe it is. What questions do you have for me? Add it in the comments for all of you down below. You can't see the charts. I know you can't see the charts. It'll be on YouTube if you're on Instagram. What is your question, however? What is your question about what's going on? And the dollar will resume strength, but it's a horrible kind of strength. It's the kind of strength that comes on fear and panic. It's the kind of strength that comes on fear and panic. Yes, it made its pullback. Do you see the dollar dominance continuing now, sir? I think it could turn and return to some strength. When there's fear in the world, the dollar gets a bid generally. But one of these days, it gets less of a bid, but it has a final spate of strength. And we haven't had that yet. So in my opinion, the USD Korean won will warm up again. Lots of things will warm up again. And I think actually the Hong Kong dollar, which has sold off to the downside, and they're saying, you see, we're right again. Watch and wait. China is in real trouble. So let's have a look at that Dow. My apologies, that Amazon high. I think that was the high. Amazon high 188. Price today is 91, which is more than half. It has lost 51%. Amazon has lost 51% from its highs after the 2021 lows. That's probably started for it during the repo market there and then there, over there. So it is actually back down. It's round tripped. Amazon has round tripped the 6-7 trillion. That was first a bonus and pumped it, and now as the price of money goes up, is actually dumping it back down. So it's back just where, getting to the levels where it was at the lows of 2020. And we have this huge potential correction. Don't forget, they want to introduce a central bank digital token. So what does that mean for silver and gold, some might ask? Deutsche Bank would have been one of the recipients. It was one of the missing banks of the 6 of trillions to keep it going. I think all banks of the macro bulge brackets will fail, is the question. What banks do you think will fail? Credit Suisse, Deutsche Bank, all of them. Do they save them and do they continue to play a role, or do they convert to CBDCs direct to citizens and sacrifice the retail banking industry to just investment banking? Who knows? Silver and gold will do better, but in this environment where everybody is falling, you can expect silver and gold to fall too. The paper price, but not by as much in my opinion, because some people that are running to the dollar will also run to silver and gold. And you can consider myself to be one of them. I will be more prone to run to silver and gold than the dollar. But I will trade the dollar. But remember, brokers and counterparty risk, FTX was a microcosm of everything else. And as a result, you've got to be aware your profits might not even ever be earned. But there are ways around this. If you want to find out more, go to themarketsniper.com, book a call, have a chat. We will be looking to trade the great collapse as best as possible, in the safest possible way as possible, recognizing that these are the times of counterparty risk. Profits do need to be taken off and converted into something that you can hold. Something that is hard, heavy, and true, and cannot be printed. Yes, sir. Yes, sir. 3 bags full. Until next time, it's Francis Hunt, the Market Sniper. Thank you for coming in and thank you for watching. We will be keeping you up to date on developments, but the prediction is rally, a short rally to the upside. If I were drawing for you, a short rally to the upside followed by a substantial collapse. And then all sorts of problems, reactions, and solutions along the bottom before an introduction of a whole new system. Thank you so much for coming on, guys, and we look forward to chatting with you further. Until next time, thumbs up, subscribe, book a call. There's real money to be made. Keep your mood up, keep your confidence up. Recognize that taking action, exercising, keeping mental health is going to keep you in a position where you are a winner in an environment where the world is going crazy. Get physical assets over digital ones. Okay, till next time. Bye-bye.